Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
Good day, everyone. Welcome to the Smart Property Investment Show. Phil Tarrant here. I'm the editor of Smart Property Investment. Thanks for tuning in. It's always good to have you with us. I'm joined by my regular co-host, Vivian Kelly. Viv, how you going?
I'm good, thanks, Phil, considering it's first thing in the morning.
I know, it's good. This is, I'm not really a morning person.
I am not a morning person, but it's well known.
A couple of coffees and I get going. I'm pretty good. Looking forward to today's podcast. We've got Hank Hong in. Now, Hank is, we know Hank well. Hank is a mortgage broker, but we haven't brought him in here to talk about mortgages.
No, it's about time. It's a long overdue date that we've had.
Hank runs, he's part of the mortgage broker, he's a home loan expert, which is a really good outfit, arranging loans for both home buyers and investors. But what was interesting about Hank was our discussions with him and just the diversity of the way he invests within his portfolio, and also coming from a knowledge base of being a broker and seeing how other people invest. It's always good to get you sort of guys on here to talk about property investment. So welcome, mate.
Is. Thank you, mate. I appreciate to be here.
So Hank, very quickly off air, we sort of spoke about, I said, Hank, how many properties you got? And it sort of was a way for me to help frame this conversation. And you sort of went, I don't really sort of talk about how many properties I've got because it's sort of in a lot of different structures and ways you do it. Can you just run me through, can you give me sort of a bit of a picture of your property investment portfolio?
Definitely. Just to give you an idea why I don't really stress too much about my properties is that I've always believed that an investment should be something that's not a headache. It should be a set and forget. So therefore, if you buy something, leave it there, let it sort itself out, and it's not too much of a headache on your personal life. Now, on the investment side of things, in my personal name, I've probably got about 3 investment properties. After that, the issues with finance, of course, there's looking at putting them into trust and stuff. And so there was investment properties in family names, sisters, and like partnerships. And then also there's investments properties in companies that I've built with other financial backers. And we've got small developments and other investment properties in that. So I'd say a handful, maybe 8 to 10. When we talk about developments, it's really two houses, but that have the potential being 10 townhouses. So the numbers, there's never really a set number. Okay. Depending on what we're doing.
So it's very fluid, and for more sophisticated investors, which I'd probably call you, that's not uncommon to have a portfolio that might look like that. So you've got a number of different things happening at the same time.
Correct.
At different stages of maturity. Some have a lot of upsides and some of them are just set and forget stuff. Correct.
And the big thing for me was that when I started investing, I did it alone for the first 2 free. Then finance, home loans and stuff, you get maxed out on that side of things. So you bring family into board. So I've done a step-by-step process. It's very hard to do it on your own. And there are people out there that do aim for 10 before they're 35 or that kind of stuff. But to do alone, I've seen that it is hard. So when I did the first 2 free, I couldn't do it. Couldn't get the finance, or was having trouble. I brought my sister on board. Then my wife came along, so I brought her on board. Then when we looked at bigger projects, then you need other financial, people with similar mindsets. And then you build a trusted company, and then you can build small developments. So it is possible to do it on your own, but it will get to a point where it will max out, and you will need to get other help as well.
So you're talking from a serviceability perspective there.
Always a mortgage broker.
Yeah, which is good. So let's have a quick chat about that.
Yes,
so what you're saying is that if you go by yourself,
yes,
you're going to get to a point where your serviceability is going to restrict your borrowing capacity.
Correct. 100%.
So you can look at how can you increase your borrowing capacity, and that is by getting greater serviceability. How can you get greater serviceability? You get more people involved. That's good.
There's that, and then what I really want to say as well is that there is no wrong way of investing. There's so many different tools. There's so many different ways. So my way was to bring family in because I'm a very family-orientated person. Other people might look at other investment ways of getting positive geared properties, buying smaller properties. So the serviceability is probably, I'd say, the most important thing out of increasing your portfolio.
But serviceability aside, do you actually enjoy investing with other people? The sort of the human interaction element, as in we're in this together, and let's try and create something not by myself, but let's have a bit of fun with it.
Everyone gets together, everyone makes a bit of money, you help your family, you help your friends, you leverage other people to help as well, and everyone together can make more money. And look forward to retirement or increasing the asset portfolio.
We chat, Viv, a lot about take the emotion out of property investment.
Yeah.
So property investment is about it's about the numbers, right? It's about making sure that you buy property, that's going to go up in value, and hopefully over time
Correct.
it generates a yield so you can cover the cost of it. But putting that human element into it, it's actually quite a good thing to do something with other people, because it keeps yourself accountable. It keeps you, it keeps the energy levels there. Sometimes when you're maybe questioning decisions or you're not too sure, it's a really good sounding board to be in.
Yeah, and I think if you're surrounding yourself with similarly sort of minded people, we have so many investors come in here and email us and talk to the show in general about how people in their life become negative about property investment.
Yes.
And, whether it's a jealousy thing or whether it's you shouldn't invest there or don't do that, or, you're making sacrifices. When you're surrounding yourself with people who don't support what you're doing, it becomes a massive roadblock to people and they start questioning their decisions. So I think if you're in it with people, if it's the right people, that can be a really good way to sort of keep you on the right mental path.
Yeah, I agree with that 100%, Phil. If everyone's like-minded, then everyone said the same negatives, same positives, and then you can move forward. But if they're on, I guess, different financial backgrounds or different ethnics or any kind of differences, you will have a clash. So you got to find the right people that everyone just goes, we want to make money and we want to make double our money, and this is how we're going to do it. Absolute no emotion out of it. It's just going to be logic and numbers. And let's say if the numbers don't return a 20% figure, everyone just goes, oh, that's off the table. Bring something else.
So is there any commonality in the way you see the world, number one, but also commonality of goals, commonality of principles towards money? And we've sort of spoken recently a little bit, Viv, about this sort of millennial Generation Y type thing.
Yeah.
And what we're seeing is that some of the younger generation struggling to get onto the property ladder are joining forces. So mates might be joining forces together. And this is sort of what we're talking about. It's slightly different because it's friends rather than family, but it is still the same principle, who go out and invest together. And sometimes it's very productive. But we also hear absolute nightmares about people who want to go down a path of investing together and then they end up in court.
Yeah, well, I mean, if you are going to go into a joint venture or sort of co-invest, I think it's very easy to think, oh, it's my mum or it's my brother, we'll be fine. But I think it is really important to have not only really clear goals, but just really clear parameters and have an exit strategy. You might not even think you're ever going to need or want to exit,
Not at all.
but that's why you end up in court. If something goes wrong, it can all fall apart. And, look, family's family, but also money's money, and it can be quite a distracting force. And so I think you really, really need to be clear and just plan for everything, because then, look, if nothing goes wrong, great. But if it does, you're ready to go and you'll know how to tackle it.
That's the big thing. Like, people believe that family will always be there for you, but people's lives change. And as it changes, it's going to affect your investment situation. So with what I've got exit ramps every single year. If you want to get out, we'll do this, we'll pay you out for this. If we haven't got to this situation, then we'll pay you out for this side of things. Luckily, I have a great family, great mum, great sister. They love me and they just go, take the money, do what you want to do. But with the professional side of things, we've got exit ramps every single year. So if we're aiming to build the 10 townhouses by this period of time, if it doesn't go between this time, you want to jump, sure, we'll pay you back this and we'll pay you this and you get out.
Yeah. I think the important point with this is that, and if you don't have a relationship with a lawyer, your accountant or even your broker should be able to advise on someone, but to actually put some documentation around these type of things, as in the agreements in terms of if you're co-investing with someone, make sure you even if your best mates or it's your sister or your brother, and often it could be sometimes quite a painful thing to actually sit there and say, if and when this all goes wrong, this is what happens. So I would recommend that you document this in many ways and actually get a letter, some sort of deed or some sort of agreement in place that says, here's the situation. If X happens, this is what we do. But I think the important point here, Hank, and this is with your mortgage broker hat on, if you co-invest into a property,
yes,
essentially both people, irrespective of whether or not they pay their share of the mortgage, are liable or responsible for 100%. The total mortgage.
Correct. If there's Mr. A and Mr. B and they have a loan together, Mr. B decides not to pay the loan, Mr. A still has to pay the loan either way. He's going to be liable and both you guys are going to get hurt. So yes, I agree with that 100%.
And have you seen any circumstances where this has happened, where people sort of end up in arrears or default on a mortgage?
It actually happens quite a lot in marriages.
Okay.
The divorces happen, and what happens is the Mr. and the Mrs., they're on separation. No one wants to pay the loan, and at that point they're shooting daggers at each other. So they just don't pay the loan, and the arrears accrue up.
and then the bank sort of forecloses and they sell the property, and that's when a good property investor gets in because they're the
property
same
investors jump straight in. So if here's a divorce case, that's where he's at the moment. And and if the bank does sell your property, they're not selling for the best price in the market.
They just need to get their money back.
Correct. So the auctioneer will just go bang, 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 smash it off, and no one wins. Like I said, investment or anything has to be really rational and logical, but marriages are emotional.
Yeah. As a property investor, many of the properties that I've purchased, and this is the stuff that we look for, is stuff that never hits the market. Stuff that never hits the market. By the time it's on realestate.com and
it's
open
too
the market,
late.
it's too late. What typically makes properties under market value? There's a whole bunch of different things. It could be how it's presented, what it looks like,
Deceased
etc.,
estates.
etc. But then you got all the D's:
Yeah.
death, divorce, and debt.
Yes.
Essentially. So it's a deceased estate, as you just said.
Correct.
There's a divorce happening or there's been a death in the family. So often a property investor will capitalise on someone else's misfortune. And it sounds absolutely horrible.
It does.
But this is the nature of the game. You know, taking the emotion out of property investment. What makes a good investment? Buying something under market value in an area that's going to go up over time.
Yes. Also, to add to that, I believe a good investment area is also somewhere that's got a stereotype, a stigmata, or something that everyone's looked down upon. So if we're looking at the Sydney market, back in the day, Cabramatta, it's my hood, it's a Vietnamese area. And back in the day, that was a very drug-riddled, criminal kind of area. Now it's one of the most expensive western suburbs out there at the moment. We got houses $1 million, we got units sitting at $600,000, and the units are over 20, 30 years old. So if you look at areas where they have maybe a strong cultural influence, a strong ethnic influence, they're great investments. Or areas that have in the past have, a lower economic, household, they're good investments as well. Because remember what we said before, an investment is a rational, logical decision. It shouldn't be emotional. In the day, you're never going to live in that investment property. It's numbers. And I've helped a mate back in the day 3 years ago buy a property in Minto. 2-bedroom townhouse. It cost him $230,000. Great buy. So in 3 years, he's made $200,000. He's bought 2 Harleys ever since. So it's
Good man.
yeah.
Maybe you should be reinvesting that into... sorry.
Yep, sorry.
So do you have a Vietnamese background? Is that
Yes,
right?
yes,
Do you mind if we have a quick chat about your perception towards money or your...
Oh, yeah, of
family?
course, 100%.
So Cabramatta, so that's where you grew up, was it?
I'm a Bankstown boy.
Bankstown boy.
It's Marrickville, Cabramatta. It's a Vietnamese hood.
So Vietnamese community sort of really originated in Sydney around the 80s.
Yes. Parents came about 80, 82.
About 88.
Yep.
So how your family's perception towards money is the Vietnamese sort of culture, is it about saving, or is there a saving culture, or is it a investing and borrowing culture? How would you sort of explain that?
Well, the early ones that came up, which would be my parents around the 80s, they're a big saving. So when they came over, they were blown away by the Australians. They loved the Australians. So the Australian dream was buy the home, pay off the loan. So even today, my parents, they have just the one house, and they're happy with it, and it's worth $1 million because they bought it over 30 years ago. But yeah, they save and they save. The next generation came through, I'd say, in probably the last 10 to 20 years. They've come over and they've started to invest a lot more because it wasn't as easy to buy the home anymore. And this is what we're seeing right now with the current generation of Australians.
Okay. And what's your sort of, coming with the cultural background that you explained from your parents' generation versus your generation as a second generation Australian migrant, you're obviously, you're an investor, so you're okay with debt. You work in mortgages, so you understand
I have no
debt.
issues with that.
So what do you think framed your mindset? So you've got both worlds pretty much. So
look, my parents were when I was growing up were big on no debt. Pay your car out cash, right? And I bought the first 2 cars with cash and all that kind of stuff. And then being in mortgages allowed me to understand that there's good debt and bad debt. And the good debt allows you to leverage to get more assets to I guess, build a better future for yourself. So that there's good debt and there's bad debt. So getting a car loan for $20,000 when you're 18, probably not the best idea. But getting playing in shares, building up a deposit so you can get an investment property, good win. So it's a big mindset that's been switched over from the older generation to the newer generation.
The good debt, bad debt thing's really interesting though, because I mean, I know a lot of people that got into huge debt around 18, 19, 20 for a car loan. And obviously the repayments on car loans are
I did it.
huge. And that sort of burned them, because then like 5 years later, they end up with like a pretty crappy car that's
Correct.
gone down in value, and they've so overpaid for it by the end that then they're just really put off debt. And then they think, you know, I know these people now, they're financially fine now that they're moving towards 30, but they still feel burned from that experience, and they still hate debt, and they still can't get their head around good debt, bad debt, because they did have that bad debt experience.
I think it's good. Yeah, I did the same. I went and bought a $20,000 car when I was, my it was late teens, early 20s. I can't remember. Yeah, I paid it off, which is good. But I completely get what you're saying. I think a sort of a flip side to that, and maybe this is a question for you, Hank, is when you look to get a mortgage from a bank, it's quite good to have a history of being able to show your ability to service debt. So it's say you got a $20,000 car loan at 20, and then you pay that thing off every single month, right on time. By the time you're 25, you've got a very good history of showing that you are responsible in terms of understanding debt and making your repayments towards that debt. And banks will look more favourably if you have that history. Is that correct?
That is correct. I would completely agree with that. It would show that you've got a better track record. But if you're coming from putting my mortgage hat back on, average incomes at the moment are sitting probably about, $60,000, $70,000, $80,000. If you've got a $20,000 card debt, your borrowing power now shoots down to maybe just under $300,000. Which pretty much locks you out of every single property in Sydney and probably quite all over the other place. So if you're 18, do not get a car debt. Get a $2,000 Corolla and drive around in that. Save your money. That's probably the best way, because these days, like you said, 25, the average age of someone, a first home, to want to buy a property or invest into a property is now getting younger and younger, because they're looking at the market and they go, I'm locked out. So I've got lots of clients that are 20, 21, and they just finished uni and they're on earning 60, 70 grand, and they're going to leverage buying an investment property because they can see clearly now that the market's going through the roof. I don't know how it was 20 years ago when people were coming out 18, 19 and looking at the market, but these days kids are just looking at it and it's like 600 grand for a decent unit. So they're getting smarter now. They're getting smarter. In the second that I've got lots of clients call up while they're in university, or the parents going, go talk to Hank because Hank will show you this and that. And I'll sit there and I'll go, don't buy the car. Don't get into credit card debt. Here's your funding position. Save up this money and come back to me in 12 months.
Yeah. So for our listeners, and this is sort of moved from you being a mortgage broker out of the rest of it. So it's good to be able to show that you can service debt, but don't hold too much debt. So if you've got a $20,000 credit card, you don't really need that. You should have a $2,000 credit card.
Correct. Close it down. Bring it down to $2,000. If you've got $2,000-3,000 left on your car loan, just knock it off. Then go get a home loan so that you can still show to the bank, look, I've paid off my debt exactly on time. But the bank would rather see I've saved 20 grand in the last 3-4 months. That shows a person that doesn't need to leverage debt. And again, good debt, bad debt, as you're saying before, Vivian.
Let's have a quick chat about the properties in your portfolio, if you don't mind. So what was the first property?
First property was about 26. So about 6 years ago.
Okay. So you first bought at 26?
Yeah,
okay.
I was actually quite a late bloomer. I was a late bloomer.
You're saying that's late. Yeah. I was going to say you started young.
Well, to give you an idea, I've been in the mortgage industry for 14 years now.
Okay.
I started when I was 18. So for someone that's been in the mortgage for 6 years and waited 6 years to buy a property, I think I was
It felt like a long time, but I think to most people it's probably quite young.
And was because the challenge of saving a deposit, was that the issue?
Well, yeah. At that point, I was still living at home with mum and dad. So life was great, earning 50, 60 grand, working in the bank. I didn't really think about property. But then the first homeowners grant came through, and that was back in the day when they were giving a bit of money, they were waiving the stamp duty, and you could still buy an old property. So my first property was, thank God, with the help of mum and dad. I still had 20, 30 grand myself. I bought a Strathfield townhouse for about $450,000. Used mum and dad as a guarantee. Got the stamp duty waived. Got $7,000 in first homeowners grant. So practically that, first home technically, did not cost me a cent to buy.
So you obviously lived in that for a
I
period
lived
of
in
time
it for
because,
about a year.
Yeah.
And then after that, I moved back home.
So 400K back then, I
Yes.
reckon that property today is worth...
It's not bad.
Because Strathfield's done very well.
Strathfield has always been the pinnacle around that area. It's the spot to be. It's right in the middle.
So you still got it?
Yes,
Still
yes.
got it? Excellent.
It's my baby.
Okay, so after Strathfield, where did you go?
After Strathfield was, again, what I was talking about was Cabramatta.
Okay.
So Cabramatta would have been about a year after that. And back then they were still going for 150, 200 grand.
Those sort of red brick 2-bedroom unit
Which is the
type
perfect
stuff.
investment.
Yeah.
It's my baby.
Yeah.
I bought that back then for about probably 200,
Okay.
250. It's probably sitting, I'd say, about maybe 460 to about 500 at the moment. Now, like I was going back before, what you said before, red brick and maybe up to 3-4 levels, great investments because there's no strata on those properties. Usually those units are quite large, 100, 120 square meters. They're built old school, so they don't fall off, they don't have defects.
There's
They're
no
double
lifts,
brick.
there's no pools,
Correct.
there's none of this sort of stuff.
So there's no actual cost. There are investments out there which have, 100 level, or maybe 30 levels or so, 3-4 pools, 4-5 elevators, and the strata's like maybe $2,000 a quarter. So even if you own that property outright, you're still paying rent on strata. Going back to the Cabramatta one, the great thing about the Cabramatta or these areas that have stigmatas or not great, how do I say? They don't look that great. And these were the great investments, I believe, are because other people go, I don't want to invest in Lakemba, I don't want to invest in Cabramatta because I've heard stories about it. But when the local person moves there to rent, he'll rent in that area. So rent figures are low. When he has enough money to buy a property, where's he going to buy? In the local area where he's working, where he knows his people, where he's comfortable. So you've got this organic organism that just feeds on itself. And then when they do well, they invest back into the area. So it just keeps going and just keeps building up.
You're just talking about property fundamentals is all it is. It's irrespective of and the logic that you're explaining in terms of the demand for properties because people want to be within their cultural, ethnic sphere of influence. That's one driver. But what does that, that dynamic, what does that cause? It's positive pressure on rents because there is demand.
Correct.
Which means low vacancy rates,
Yes.
which is good for an investor.
Mm-hmm.
It means that you've got generational cycles. So people coming in as renters, they like the area, therefore they want to upgrade into owning a property
Correct.
in that area. So there's positive pressure on price. So prices should continue to go up. A lot of the areas you explained, they're all in sort of west to southwest Sydney,
Correct.
but this is the same dynamics irrespective of where it's in Melbourne or Brisbane or
I'm
Perth.
not saying it's the perfect investment ideal. There's plenty out there, but it's the strongest one that
It's the
I've
drivers.
seen.
I think the important thing for our listeners is about their drivers. What's going to make property go up in value, and what's going to make your rents, or how you're going to be able to rent your property and make sure your rents are sustainable.
And it's sustainable on something that's organic rather than I don't like trash talking other stuff, but like an area which is dependent on, let's say, mines or dependent on tourism or dependent on something. It's organic. It builds
there's
itself.
jobs. There's
Correct.
jobs. People want to live there. There's infrastructure. There's everything you need to actually stay within that particular area. It makes a lot of sense. So the message for our listeners is to understand what the drivers are for why property goes up in value, and you've just explained some of them. There's a lot on smartpropertyinvestment.com.au. We write about it all the time, don't we?
We do.
The fundamental stuff. I think we've run out of time. Have we?
We have. We always do.
I know.
It's sort of time gets away from
Sorry
us.
about
There's
that.
so
We've
much
been
that we
going
could
for
talk
about
about.
half an hour. Hang on. You're gonna have to come back in and chat a bit more. I think.
I would love to. I'd love to.
Really enjoyed it. We're sort of a bit of a mishmash of a
Oh, yeah,
podcast
it's-
between you being a mortgage broker and some of your experience in that regards, but you also as a property investor.
Yeah.
It's a good combination of both. I think your mortgage broker is someone that you should see because they know how much you can borrow, so therefore they can give you an idea. They're unbiased. They're not selling you a property in certain areas. And the mortgage broker is someone that's, I guess like myself, I've dealt all around Australia. So that means I've seen so many different investment tools that other people do. I've seen, I know the areas that my clients have invested in, and they usually tell me, it's good because of this and good because of that. Rather than going to just a real estate agent that's just, I only sell in Abbotsford. So the mortgage broker is important because he knows how much you can borrow, how far you can go. He's seen a lot. He's done a lot of application. He's seen different types of investments: granny flats, duplexes, developments, mining towns, positive geared investment portfolios. So speak to your mortgage broker.
would you recommend that your mortgage broker should be an investor themselves?
Yes. You definitely. I've sat down with many of clients and they've gone, "What's your portfolio like?" And I'll sit there and explain to them. And one of my portfolio strategies might hit exactly what they're thinking in their mind. And that's important, knowing what your client wants and your client understand that you know that what they want. And that keeps them at ease and they will tell you everything. And then you can open up and run through their situation for you. You're not there for advice. I'm never here for advice. I'm just here for, look, I've seen my client do this, do your own research and see how you feel about it. And if you've got an investment rate right now that's more than 12 months old, your rate's too high. Your rate is definitely too high. Go speak to your mortgage broker.
Some good advice.
It's good. Yeah. But I'll close with this. I've got 3 mortgage with a particular bank, and
your interest rate went up 12 months ago.
I can't remember. I was doing something. I can't remember. But I looked at the interest rates. I can't remember what I was doing, and I checked it out, and I looked at them and I just went, "Hang on a second. What's going on here?" And they were so far over what market should be.
Yep.
So
Definitely.
I called my mortgage broker and said, probably had some expletives in there. What's going on here? This ain't cool. So he got straight onto him and got the rates down.
Yep.
So
He'll either get the rates down or he can move you. So right now, a lot of the banks are stepping back into the investment market. There are amazing fixed rates under 4%, and there's variable rates. A couple of the majors, or actually the non-majors, they're under 4% at the moment. So have your mortgage broker run a quick scenario for you and make sure that you're still competitive.
Fixed or variable?
That's a question that everyone asks all the time. All right. So what I say is, I've always thought the rates were going to stay the same for the last 24 months, but they keep going down. So I've been wrong every single time. I fix my rates because I like like I said at the start, I like the ease. It's fixed. I know the repayments are exactly that much, and I know the rent's going to be that much. It's a set and forget, and it disappears. At the moment, all the fixed rates are sitting under 4.2%, 4%. It's great because rental yields are sitting at 5, 6, 7%. So I don't tell people to fix rates, but it's up to you. If you fix 3 to 5 years under 4%, I can't see you losing. Even if it goes down once, I can see in a couple of years' time, even 12, 24, the rates are going to be higher than 4%. So to fix in is not a bad way, and it locks your investment down. No headache, the rent pays it, and you move on.
Yeah. So speak to your mortgage broker.
Yeah, speaking of the broker.
Anything to finish up with, Viv?
No, I think that's it. I think it was really interesting to have Hank wearing all of his different hats.
Yeah.
And I think we'll probably need to get him back in to sort of delve more deeply into the way that he's structured his portfolio.
I would love to. And if anyone's hearing, if you make comments, tell us exactly what you want to hear. And I'll come back next time and go more deeper into that side of things.
Cool. Nice one. Thanks, Hank.
You're
Appreciate
welcome.
you coming on, Viv. Thank you.
Thank you guys for having me.
Thanks for tuning in, everyone. Remember to check us out, smartpropertyinvestment.com.au. You can email us if you've got any questions, and we get plenty of them. Editor@smartpropertyinvestment.com.au. Viv will get back to you as quickly as she can. If you've got any particular questions around the smart property investment portfolio, or Hank in particular, or anything we've spoken about, just drop us a note and we'll get onto it. You can follow us on all the social networks, Twitter, Facebook. You can follow me on Twitter @PhilipTarrant. And that's pretty much everything, I think.
Yep, that's it.
Cool. All right. We'll see you next week. Thank you. Bye-bye.